morning, everyone, and thank you, Keith. Thank you for having us. And I think it's probably not a coincidence, perhaps, that I'm speaking right after Keith. We are likewise Latin America focused. We're a geothermal energy company at the moment, and more broadly, renewable energy. So the focus will always be renewables for us, and currently operating out of Nicaragua. So I'll comment a little bit on that, but not gas, renewable energy, a lot of those macro points I think very much would apply to us and what we've seen, what we've experienced in Nicaragua. The government's reputation globally and with the United States is certainly not the best, but in terms of attracting foreign investment, they've certainly been doing a lot of the right things for many years now. So we've actually been quite positive in that regard. There we go. Okay, so I've tried to break this into three pieces for you. I'll talk a little bit, fairly briefly, about a little bit of background and history on the company. We were recapitalized in 2015, so it's great to have that in the rearview mirror. That involved new management, myself and Mark Murnahan as CEO, as well as predominantly new board of directors. And that also coincided with fixing the balance sheet, and I'll touch on that a little bit further, but the balance sheet definitely was not working historically, and as part of that recapitalization, we've ended up in a much better spot. And then as well, I'll include some brief comments on what we've done in 2015-16 as a new management team. Second piece, we'll really try to focus on some near-term opportunities, and the main point here, I think, is that these are opportunities at our existing asset. Thirdly will be some of the longer-term view, which for us starts to think about M&A and some comments on our dividend, as Keith has already alluded. So a quick snapshot, so some points here, 15.5 million shares outstanding. We're entering 2017 with over $45 million US on the balance sheet, so that available capital is a point you'll hear me refer to in a few occasions. Fundamentally, that's enough to fully finance the projects I'll speak to as our near-term opportunities that are already in front of us. Run rate EBITDA in the neighborhood of $50 million US, and we do have a quarterly dividend. Just a few weeks ago was increased from 11 cents up to 12 cents US, and so currently that's in the neighborhood of a 4% yield. Okay, so some comments on the existing project, the existing asset, why we think that's compelling and what makes it special. So sort of fairly briefly, the balance sheet was fixed, fresh equity was raised, as well as, very importantly, restructuring of our project level debt. That occurred in May of 2015. It was at that point that Mark and the new board, and very shortly thereafter myself, got involved. And then I'll also include some comments on what we've done execution-wise and results-wise in 2015 and 16. Here's a snapshot of pad 12 at the San Jacinto geothermal plant. And I thought this is a good one because it effectively has everything. You can see the largest, tallest structure there is a separator station. So we're getting hot water and brine coming up from the ground, goes through, so that's a production well, goes into the separator station. We take the steam, pass it through a turbine, and create electricity, and we re-inject the hot water. And the hot water being re-injected at about 155 degrees Celsius. I'll comment on that shortly in terms of one of our near-term opportunities. So some brief background. Again, we are operating the San Jacinto geothermal field is in Nicaragua. We've got a PPA. So the PPA is in US dollars. It runs out to 2029. It provides us an attractive tariff for 2017. That tariff will average around 12.3 cents per kilowatt hour. And that tariff will actually escalate for the next 5 years at 3% and 1.5% thereafter. And then, as you can see, I've underlined 72 megawatts. So that PPA will pay us up to 72 megawatts. Next comment is we have a plant. Like Keith said, arguably one could enjoy a meal off the floor, but that plant is rated, the two turbines, at 72 megawatts, not coincidentally. When we took over as a new management team, the plant was operating at around 48 to 50 megawatts. And so the key point that I'd like everyone to try to take from this talk today is that there was a lot of headroom there, a lot of operating leverage to be had, where effectively 100 cents on the dollar of any additional revenue we could derive would fall to the bottom. It's not quite, but it is actually quite close. And so building on that point, the 2015-16 plan really revolves around executing on that strategy, leveraging physical and a legal framework that would allow us to really generate ultimately additional cash flow. And so that's what this slide will show you. We see 2014, 15, and 16, some revenue growth in 2016, but you see significant cash flow improvement from 2014 to 15, fundamentally reflecting the debt restructuring, and then further significant run rate annualized cash flow generation in 2016, reflecting the addition of 2 new wells. So that was really that investment into our existing project. So a bit of background there. I'll be actually quite quick here on the near-term growth opportunities, and I think part of the point there is that ultimately these are quite straightforward. We have the capital to do this, and the first one is to drill an additional well, and the second one is to do an above-ground piece of infrastructure. So drilling another well, again, we have the capital to finance this, so it's strictly about making a decision and executing. And then in terms of some metrics, some return analysis, that if we were to get an average well, something in the 5 to 7 megawatt range, that would cost us around $7 million, and we could be looking at a 1 to 1.5 year payback. There is drilling risk and geothermal risk, so there's risk, and I think that sort of corresponds with what could be a very compelling payback period. And you'll contrast that a little bit with our second near-term opportunity, again, at the San Jacinto field, which is a binary unit. I will not get into the technical aspects of that, but in short, it's taking that hot water I referred to, 155 degrees Celsius, extracting some energy from it and creating additional power through that means. So this would be in addition to our existing sort of operating capacity. And the risk profile here is quite compelling. No exploration risk, no drilling risk, very low, we think, technical risk, and paybacks not as compelling as drilling, but again, not nearly as risky. So we're talking a 4.5, 5 year payback is what we view here. And then if we just look at the blue bars, it gives you a bit of a snapshot of what we think if we're able to execute a new well and execute on the binary, what the next couple of years can look like. Just a quick view of what Pad 6 looked like about 1.5 years ago this time. We were drilling well SJ63. It gives some sense of the scale and scope of what we were doing at the time. And that well is now connected and contributing to the plant. And final section around some long-term comments. So a little bit of the background I've provided, what we did in 2015 and 16 and being restructured, as well as what we're targeting for 2017-18, and long-term focus is really, the comments will be around M&A focus, growth, as well as our dividend, which can provide that yield. So we think we can be a compelling opportunity in both respects. So acquisitions, and again, I think a lot of the things you heard from Keith would, broadly speaking, would actually apply here. The grid in Central America, quite small, quite fragmented. At 50 megawatts generation, we've actually been around 10 to 11% of the Nicaragua grid. So you can get a sense, Nicaragua can't have a 500 megawatt massive plant. It just doesn't work. It'd be far too risky. And so that you could really extrapolate that across the region. So we think that we're a good size in that sense in terms of looking at opportunities to acquire. And then really the second point there in terms of a lack of access to capital. Fundamentally, Latin America does need foreign investment. And many of these projects, family-owned, and either they're perhaps willing to consider just a liquidity event, but more likely, they want to keep growing. They just don't have the capital or the willingness to invest that capital, whereas we think that's very much up our alley. And IRRs in the 15 to 20% range, which is 50 to 100% more than we'd likely expect looking in North America. And a slide on our dividends. So you can see we initiated in Q2 of 2016 at 10 cents, raised it a couple of quarters later to 11, and very recently to 12. And you can actually see payout ratio going the other direction, reflecting really strong cash flow. So in short, we think we've got some room to grow as it relates to dividend. And that's it. A summary is the strong execution and fixing the balance sheet behind us, I think, makes it a very de-risked business and an attractive entry point. We do think we've got some near-term opportunities in front of us for 2017 and 18 and have the capital to execute. And then we also think there's some compelling long-term aspects, both M&A on the growth side and a sustainable and growing dividend on the yield side. And that is it. Thank you.